What's up guys, I'm Paul and welcome to the channel. So when it comes to investing, which is the best strategy? Is it better to put a lump sum in and just leave it to do its thing? Or is it better to make regular monthly contributions to your portfolio? Well, I wanted to find out, so I set about doing my own research, and for this I needed a calculator, and I found this really awesome one on this website. I can't remember the exact URL because it's just seemingly a random bunch of letters, but I'll leave a link to it in the description below if you want to go and check it out for yourself and have a play around with it. But it's a really good calculator because it's actually based on historical data from the S&P 500, and what you can do is you can put in date ranges and different amounts, basically lump sum amounts and monthly amounts, to get estimated returns on what it would be over that period. So that's why I decided to use this calculator. Now this calculator does work in dollars, but I've just switched the dollar symbol out for a pound symbol because, well, I'm British and it's just easier for me because I don't feel quite comfortable saying dollars. It just doesn't roll off the tongue for me the way that pounds does. And for this, I decided to set a couple of parameters. I decided to go with a 20-year period and also invest in £24,000. And why did I pick £24,000? That seems like a pretty random amount. And it might do when you're looking at the lump sum. But when you're looking at monthly, that works out at £100 a month over a 20-year period. So it's investing the same amount of money over the same amount of time, one doing the lump sum and the other one doing the monthly contributions. Now I am going to have to reference my notes on this one because I can't remember the figures off the top of my head. I'm not that good. And the 20-year period I looked at was February 2002 to January 2022. I still find that really hard to say. It just doesn't really roll off the tongue, does it? 2022. But this was the period I looked at. And if you'd invested £24,000 in February 2002, going to look at my notes now, you would have had a return of £146,233, well, an estimated return of that. But what about if you'd invested £100 a month? Well, your return over that 20-year period would have been £92,034, which is a difference of nearly £55,000 between the lump sum investing and your regular monthly contributions, which is a big difference. But some of you eagle-eyed viewers out there might say, but Paul, if you was investing in February 2002, you'd be investing when the market was in a downturn, because we was just coming off the dot-com bubble and we'd just gone through 9/11 as well. Two major events that had really put the market in a downturn. But I also thought of that, and that's why I moved the investment period back 2 years. So I started at February 2000, which is just before the peak of the dot-com bubble, to January 2020. You know, before the world started to go mad. And the figures are somewhat different. And if you'd invested that £24,000 in February 2000, your return would have been £82,604. So quite a lot less than if you'd invested that lump sum 2 years later. And if you'd invested £100 a month over that 20-year period, your return would have been £70,701. So that's nearly £12,000 difference. So the gap has narrowed quite a lot between the lump sum investing and the monthly. But the figures still speak for themselves. You would have been better off investing a lump sum and leaving it over that 20-year period than investing a regular amount on a monthly basis. But there's one thing these facts and figures don't take into consideration, and that is emotion. Because when we're investing our own money, we have an emotional attachment to it because we've worked hard to make that money, whether it's through your job or the way I've done it, through building businesses. We work hard for that. And the one feeling we hate more than anything and we try to avoid is that feeling of loss or that feeling of losing. We just don't like it. And anybody who's ever been involved in any kind of competition will know exactly where I'm coming from with this. If you've ever lost, it sucks. You don't want to feel that feeling again. And we have a similar kind of feeling when it comes to our money as well. We don't want our money to lose money. It's a simple fact. That's why when people invest and then there's a downturn, a lot of people will sell because they don't want that feeling of losing more value on their portfolio. But I'm going to go more into that in another video. And that's why if you'd invested in February 2000, just before the peak of the dot-com bubble, you would have had to have serious diamond hands to stick out through that time period, because when the market started to crash, you wouldn't have seen your portfolio back in the black until around about January 2006. So nearly 6 years your portfolio would have been in the red, and at the bottom of the market it would have been worth around about £17,000, which is a big loss to try and stomach. And a lot of people probably would have sold out before then. They wouldn't have tried to stick it out because they hate that feeling of loss. And that's why for me personally, I prefer the dollar cost or pound cost averaging. pound cost just doesn't have the same ring to it, does it? But that's why I prefer investing on a monthly basis, because it doesn't feel like I'm on such an emotional roller coaster, because I'm buying some months I'm up, some months I'm buying it when the market's down. But I feel like I'm just kind of riding that wave, rather than if I'd put a lump sum in, I'd probably be stressing about it. I'd probably be checking it like a hawk every single day to see what's happening with it. Whereas the way I invest every single month, well, actually I'm investing every single week at the moment, but putting that money in on a regular basis, I just don't find it as stressful. And one final thing before I wrap this video up, and that is that only a small percentage of people would do the first method of investing a lump sum and leaving that for 20 odd years. Most people wouldn't do that when it comes to investing. If they had a lump sum, they'd probably invest that to kind of kickstart their portfolio, but then they'd make regular monthly contributions to their investment portfolio as well, because then you're getting the benefit of both worlds. You've got that kind of lump sum working for you, and then you're also topping that up on a regular monthly basis. And going back to the two figures of the two 20-year periods, if you'd done the £24,000 initial lump sum, then £100 a month, from February 2002 to January 2022, your total portfolio value would have been £238,267. And if you'd invested in February 2000 to January 2020, your total portfolio with a £24,000 investment, then £100 monthly contributions, would have been £152,961. So say with that way, you're getting the best of both worlds, and that is what most people who have got a lump sum to invest would probably do. So I hope this video was helpful and informative. I definitely found it quite interesting figuring all this out. If it was, a like would be absolutely awesome. Also consider subscribing for more money related content. So thank you so much for watching, guys. I really do appreciate it. Stay awesome, and I'll see you in the next one.